my friend, mentor, investor relations partner, investor in my deals, joke making, snowboarding buddy of mine. Good morning.
Good morning, Chris.
Isn't that an amazing intro? Jeez.
That was, I mean, I could just ping pong that one right back to you, man. All those same things, mentor, partner in success. Yeah. Snowboard buddy. Good to see you.
Well, the snow is starting to trickle down in the mountains. That means we will be doing some weekday turns in the next, I don't know, 2 or 3 months.
Yeah,
Get ready.
looking forward to it. Yeah.
Yeah. All right. So what we got this morning, we're both on old Lon Welsh's email list, Lon of Your Castle Real Estate fame, of Ironton Capital fame. I used to work with him when I was the head of investor relations at his private equity firm. Love Lon. He's a data machine. Look what he sent us this morning. We're talking about this equity that is stuck in, quote unquote, stuck in houses. Equity withdrawals on mortgage properties in the U.S. Look at that sucker decline.
Oh, yes.
Everybody knows the story, but I don't know how deep people are really thinking it through. With interest rates so high, Americans are not tapping into their home equity via HELOCs, via cash out refis. And what does that do? That slows the economy.
Yep.
So the Fed's intention and technique is working, right? Because, less HELOCs mean less new bathrooms and less new kitchens and less new whatevers, right? And even he highlighted right here, for homeowners, this is a bummer. Folks are putting off kitchen renovations.
Yep.
So this is a reduction in not a few bucks. We're talking billions and billions of consumer spending. Give me your take on this, man.
I like you said, we've seen it. We've been living it. Just trapped equity, man. We've been looking for ways to free up trapped equity, and right now, like, the best option for that is through sales of assets. If you're really going to tap that equity, otherwise you're looking at cash out refinance rates of near 7%. My HELOC currently has been hovering around that 7.5%. I think it was as high as 8. I can't even remember. I mean, I will still use that vehicle, my home equity line of credit, but I'll tell you what, I am certainly not utilizing that as hard as I would like to, just because the rates are high. So it's absolutely doing, like you said, it's slowing the economy down. So it's doing the trick there. But this is the stat that jumped out to me here. In 2020, the amount of equity that homeowners had was $6 trillion, right? By June of this year, that had grown to $10.5 trillion. That is just a lot of equity sitting on the sidelines for a lot of people. And a lot of people aren't really able to tap this because of the golden handcuffs, right? So many of us refinanced when debt was cheap, coming out of the pandemic. I know I did. I refinanced everything I had. And I'm in that same boat. I didn't want to touch that. I didn't want to refinance that once rates doubled. So what are you going to do?
Well, yeah. Why would you do a cash out refi at 7% when you're locked at 2.5%, right? Mm-hmm. Talk about golden handcuffs. And that's not only, reducing people's access or, desire to access their equity to then turn that into what we call consumer spending, right? Yeah. But it's keeping them in their homes, yeah. Right? You're in your house, you've got a 3% interest rate or 2.5% interest rate on a 30-year fixed. And you look at downsizing or upsizing, and you're going to a 6.5 to a 7.5% interest rate. Let's just call it 7. That hurts, especially since the prices haven't come down, right?
Right. So, it not only hurts, it makes it so people can't even do that, right? They don't have enough income to support the debt, let alone would you want to, especially coming out of the high inflation period where we came from here. Everything was so expensive that you're not going to want to like double your home payment, right? I certainly wasn't looking to do that.
Right. I mean, I'm still using my HELOC to a degree on these little micro micro debt moves, right? Because I'm a lender and I've got a little hard money lending business, a little debt fund, and so if I can borrow money from my HELOC, again, this is what I do for a living, so I'm not encouraging everybody to do this, but if I can, access, let's say 100 grand in my HELOC and lend it to somebody at 8%, and then lend it to somebody at 12%, okay. I mean, I'm still willing to do that, and I can underwrite debt and all that, but no, I mean, I've been using my HELOC for many years to go buy, fourplexes. But even that doesn't make a lick of sense right now because rates are high and prices are high. And so I think, I don't know, you tell me what you think. I think the only thing holding up this housing market is simply lack of inventory, right? If there's inventory, we would see a dip in prices. That seems to be the last pillar that these prices are holding on to, or these prices are propped up by, is just simply the lack of inventory. What do you think?
Oh, couldn't agree more. When we started seeing rates go up, a lot of people were thinking there's going to be blood in the streets. I had a client that was looking to buy last year, and he was completely freaking out about it. He's like, I don't want to buy this house because it's like, in a year's time, that's going to be worth 20% less. And I was telling him, like, I don't really see that much of a dip coming. I was really thinking, we could see somewhere that 5 to 10%, but like 20, 30%, like a complete fallout. Like so many people were thinking that it was going to be like the big financial meltdown of like 2010. And I was just like, no, there's too many factors that are different about this hiccup than last time. And so you're absolutely right. If we had the inventory, and again, we've been in low inventory status here in Denver for a long time, but we went from low inventory to extremely low inventory to now like ridiculously low inventory. So without that and high rates, you would have seen a bigger dip in prices. But people are locked in, like you said, they're not moving. They can't. They don't want to. Whatever the deal is there. So we have a nice mix of rates went up and the amount of inventory went down, and that's kept everything in a pretty nice balance.
Yeah, I read a poll, I forget who published it, just a few days ago, that was asking people what interest rates would need to be to get them off the fence, right, to sell, to buy. And the poll, the average was 5% interest rate. Okay. And for a 30-year fixed. And I'm going, don't hold your breath, right? Right. That's not coming soon. And what I tell people, when you're like us, you're born in the 70s or earlier, we remember our parents getting, or at least the stories of our parents getting houses with fixed interest rates in the teens, right? Oh. Being 14, 15, and they'd be tickled to death just to get that. So historically, to have a 30-year fixed at 7 is not bonkers, right? What makes it bonkers is, the 10,000-foot view, or in aggregate, right? When you have prices and rates and lack of inventory, it's just, it creates this kind of behemoth that is so slow moving, and real estate is always slow, right? I mean, a real estate crash takes years. 2008, 2009, that didn't bottom out till what, 2012?
That bottom kind of went through 10 through 12. Okay. It's weird. I've talked to different people who kind of see it in different spots. I was lucky. I bought a couple properties in 2010, and from the charts that I was looking at for here in Denver, it looked like I bought right at the bottom. History made me look like a genius, but the reality is I just had a child, and I was getting going in my real estate investing career, and I was just looking to make moves, and so I was active. But it turns out I was one of those people running into the fire when everyone else was running out. Yeah. And it's, I bought buy and hold property at that time. So that ended up being a good move. But right now, for people, like you're saying, with high rates and high prices and low inventory, if you can stay put, of course you're going to. But the big effect, like we're seeing, is, like you said, the Fed's raising interest rates is having the effect that it's desired to have. There's less consumer spending. Like you're saying, there are a lot of people who, unlike you and I, who will use a home equity line to go out there and have different opportunities for investment. A lot of people will use their house as a piggy bank, right? They'll pay for that kitchen, $60,000 for a kitchen, and have the house pay for it. And really they're only robbing themselves of like that equity, that future net worth. So a lot of people who are using their houses as piggy banks, that certainly slowed that down, which I think is a good thing. I mean, you and I tend to be a little more maybe financially responsible than your average bear, but so I think that's good for people in the long run, but it sure is slowing down the economy.
Well, yeah, as a lender, I've seen people use their HELOCs wisely and their HELOCs very poorly. So I think a new kitchen with your HELOC, if you increases the value of your home, I think that's a decent investment. Or to improve a bathroom, I think that's an investment. Where people get in big troubles when they take their HELOC and they go buy a boat, right? Or they go on a big vacation. That is reckless, in my humble opinion. And we've seen people use those things wisely and poorly. And listen, some people just you go through hard times, right? And you might acquire, whether it's through medical debt or whatever, you might acquire some serious debt, and then some people lean into the value of their home and they do a cash out refi and settle up their debt, right? And so if you've got credit cards at 18%, I'm using some extreme numbers here, but if you got credit cards at 18% and you can, borrow against the equity in your home and do a cash out refi at even 7%, well, yeah, that makes sense. But remember that you're paying off, let's say you're paying off $100,000 worth of medical debt, and then you get 7% on your home loan. That's $500,000. Well, because that's such a big chunk of money and you're slapping 7% on that doesn't make sense, right? That starts to look pretty ugly pretty quick. And if you're locked into your 2.5% or 3% loan, yeah, the math doesn't pencil pretty quick. And as a lender over the last decade, I've done plenty of cash out refis so people could settle up on their student loans, right? Yep. If let's say their student loans were 7%, and they could do a cash out refi at 4 or 5. Right. Duh, you do that, right? And especially if you're out, if the loan's $200,000, right? $300,000, and you're paying off, $200,000 of student loans. Well, that makes sense. But as these things get extreme, right, you can't take a big rate on a big chunk of money to pay off a ginormous rate on a little chunk of money, if that makes sense.
No, that does. That's not going to make sense. Yeah, it'll be interesting to see. I know a lot of people are talking about thinking that mortgage rates are going to go down about a percentage point. Are you in that camp in about the next 6 months or year?
Absolutely not. I'm in the camp of I don't know, and nobody knows. Even the great Case and Schiller will not put their stamp of approval on the direction interest rates go. The only time I'm good at predicting interest rates is the same day you see a big move in the 10-year treasury, right? So if that's the only website that I would consider. So if you're buying a house, and I'll go check out the 10-year, and if I, remember it's mortgage rates are generally directly proportional to an indicator and inversely proportional to another indicator of the 10-year. And so it's really simple. I go there, I look at if the squiggle is going skyrocketing. I won't even ask you. I'll just lock your rate if you've just bought a house or if you've just got it under contract,
the process,
right? Or if it's diving, I'll go, hey, Matt, we're going to chill for a day and let that adjustment go through. That's the only time I've had any accuracy of predicting interest rates, and extremely short term, like same day. Look at the bond market, the 10-year, and it's nobody's got this dialed in. And I hear plenty of people making these bold predictions. And I even did a video on this. I would recommend buyers, investors, look at the track record of people predicting those, and then they'll learn that they don't have a track record of predicting the ebb and flow of mortgage interest rates. No, at least I haven't found any. And I get emails on rates every day. I get, I read about this stuff every day, and I'm touching it every day as a lender, right? So there's my long-winded answer of I don't know.
You don't know. None of us know. I guess where I was kind of leading that one, though, is more in the thought of people say what was that, 5.5%, if rates came down to, then they'd be free to move about the country and buy and sell and do whatever. I wonder what the reality of that number is. Like I do feel like we're going to see rates drop, but that's just, again, I can't prove that. I can't say anything other than I feel like they will come down, whether they come down a half point or a whole point in the next 6 or 9 months. I wonder though, if we do get back down to 6.5%, because people have gotten used to 7 and a little higher, if we'll start to see things move more.
Maybe. I mean, the one thing I can guarantee, and yes, I'm saying that crazy word,
Whoa, you
guarantee.
don't say that word.
You generally don't say guarantee in lending or investing, but listen to what I'm guaranteeing. I'm guaranteeing they're going to wiggle and squiggle up and down. There's a guarantee. I don't know how much. I don't know when, but if you don't have to be a genius to know that rates go up and rates go down. So I don't know. For me, you're just always you're always in the game, right? I always want to be in the game, and our game is real estate investing, right?
Oh yeah,
lending money and investing in real estate, and if it works, it works, right? So if I can go get a 10% loan, and that deal's going to yield, a gross of 15%, and I can make a spread, okay, then it makes sense, right? It's just, right. I like this phrase, in aggregate, right? Yeah. In aggregate, what does it all look like together? People, I was talking to a guy at my jiu-jitsu academy. He's a young guy. He's never bought a house before. He's looking at buying his first house, and he goes, rates are just so incredibly high. And I'm like, are they? Because they've been in the teens. Why do you think they're high? And in aggregate, sure, right? Prices are high, rates are high. Real estate's expensive right now. Residential real estate's expensive right now. But just because you heard somebody on CNN say rates are high, I mean, look at the full picture, right? Get some more information. Listen, we'll still do deals. I still bought a triplex in the midst of this craziness, because deals still pop up. Now those deals are far and few between, right? And the only deals that you and I are really seeing consistently are these private equity funds that, where you get exposure to these institutional grade investors, and they're capitalizing on apartment complexes and those owners getting beat up by these high rates, right? So these investors who maybe have a 3-year note, 5-year note, and they're coming due. I mean, we both know there's billions of dollars worth of commercial debt in multifamily coming due Q4 2023, right? We know that. And we know there's a bunch of syndicators and fund managers hurting. And so if you can partner up with, and invest and be an LP with kind of the more conservative, the more seasoned, the more vertically integrated, at least that's where we've found we can put our money. Oh yeah. There's no single family homes to buy as an investor that makes sense, or there's no duplexes or fourplexes or even these little deals. We're finding them with these top tier operators that, you hope you can get exposure to. I don't know. What do you think?
No, I think you're absolutely right. The thing I was kind of thinking about is just more the masses, talking about how people aren't tapping this equity because rates are high. And a lot of it is a psychological effect on them. And again, we're not going to solve that problem. What rate is going to make people feel comfortable that this is a good enough rate to go out and buy that house? Like the example of your jiu-jitsu bud there. Because I've certainly heard a lot of people talking about that too, because rates are so high. But yeah, here's the thing. People have this mindset, and it never serves them well in real estate. I'm going to wait for prices to come down, or I'm going to wait for interest rates to come down, or some combination of the two. You can wait and wait and wait and wait, and maybe you'll never get to that sweet spot. In my life cycle as an investor, 16 years, I've seen one optimal moment like that. Like I said, that was after the 2008 crash.
Yeah, and you didn't know. You didn't know it was optimal. You're not a genius. You stumbled on that one. You got lucky. And I don't think we know anybody. I mean, there's just very, very few people who accurately predict the bottoms and the tops. I'd like to think I can see a general bottom or a general top peak, but I don't know, and those who are so confident, the what is that guy from The Big Short, that doctor who predicted the Michael Murray, something like that. These crazy geniuses, I mean, they only get it right once in a lifetime, right?
Yeah,
maybe.
We only know that we were right or wrong when we've had enough data. We're far enough out that the data shows us, the true ups and downs. And so we just got to get out there and do the best we can. I think though, with this particular situation right now, I think a lot of people aren't making these moves. Like I said, it could be the psychological factor, but I think a lot of it too is they can't afford to. They can't afford to the rate of the debt, and I totally understand that. You'd hate to see somebody overextending themselves, getting themselves into a problem because they over leveraged at high rates. So,
well, the way to bring it all back down to earth, right? Like kind of get distracted with all the other stuff and predicting that other people can't predict and all that. But no, and the bottom line is the debt's too expensive to move for many, many people. The debt's too expensive to pull out and fix your kitchen. And the fact that you're paying more money than you've ever paid potentially in your lifetime for all the other stuff in life, right? All the other consumer goods, gas, and the fundamentals, food, etc. No, you're spot on, right? At the end of the day, you've got to be able to afford what you're buying. And people who, we know this, people who can't afford what they're buying and keep buying, that generally doesn't end well.
No.
No, it doesn't.
I think, rates are high. Hold tight if you can, or like you say, find another opportunity as investors, like we've found different ways to tap into that equity. And like I said, the only one that I found that works for me currently is sell, take advantage of the low inventory in that regard, and tap that equity that way. Because I looked at doing HELOCs, I looked at doing cash out. None of that was going to work well. So that's where I am.
Yeah, I'm with you. Well, once again, great conversation, my friend. What, as you know, I like to end it with a little gratitude. What are you grateful for, buddy?
I'm grateful for snowboard season coming up. Like you said, my daughter just turned 15 and she's fairly full grown. So got her equipped with new snowboard gear. Her birthday was just a couple weeks ago. And so that's got me real excited and looking forward to the season and sharing that with the kids and you.
Yeah, dude, it's going to be awesome. I'm with you. I'm thankful for the POW that is in our future, my friend. All right. I appreciate your time as always. We'll catch you on the next one, buddy.
All right, bud. Take care.